But if you're thinking 10, 15, 20 years out, whether you bought gold at 3,300, 2,900, or even 1,800 is going to be immaterial. My target, like Ronnie Sturflis for the next couple of years, is 4,800. But I think it's going, and again, I'm not saying this to just throw it out there. We're going to revalue gold. It's going to be part of the new reset whenever and however that involves. It's certainly replacing the 10-year. We're looking at gold at 10,000 conservatively, not next week, not even next year. Could be, but I have no idea how to predict that. But if I'm looking 10, 20 years out, it's going to be much, much higher than it is today. And whether you bought it 33 and change or 36 and change will be irrelevant in the long run if you're thinking that way.
Matthew Piepenburg, a precious metals strategist at GREYERZ, presents a compelling case for gold's dramatic price appreciation in the coming decades. His analysis suggests that $10,000 in gold represents not an ambitious target, but rather a conservative long-term projection that reflects the underlying fundamentals driving the precious metals market. Piepenburg's bullish outlook extends well beyond current market conditions, with his projection spanning the next 10 to 20 years. He argues that gold will trade at levels far higher than today's prices, making the precise timing of entry less critical for patient investors who understand the long-term trajectory of the asset. This perspective shifts the focus from short-term market timing to strategic positioning for what he views as an inevitable price appreciation. The 2025 gold market has already demonstrated remarkable strength, with prices surging to new highs. This rally has been significantly influenced by President Trump's tariff policies, which have created additional inflationary pressures and currency concerns that historically drive investors toward precious metals as a hedge against these risks. The current momentum suggests that the 2025 gold market outlook will be a crucial factor for investors developing their portfolio strategies. Central to Piepenburg's analysis is the dramatic erosion of the US dollar's purchasing power since America abandoned the gold standard in 1971. His calculations reveal that the dollar has lost a staggering 99.1% of its purchasing power when measured against a milligram of gold over this period. This metric provides a stark illustration of gold's role as a store of value during periods of monetary debasement. The dollar's decline becomes even more pronounced when examined through different analytical lenses. While some measures show the dollar has lost over 87% of its purchasing power since 1971, other gold price analyses suggest the decline could be as high as 98% when accounting for changes in how inflation is calculated. These methodological adjustments in inflation measurement have potentially masked the true extent of currency devaluation. Before we begin, don't forget to like, share, and subscribe. 97.4% of viewers haven't subscribed. Join the 2.6% who have by hitting that button and turning on the notification bell so you never miss an update.
You could argue on a technical basis that gold is still a good price in the 3,000, the 3,300, 3,400, 3,500. That seems hard to believe. I remember having this conversation with gold at 2,600. I've missed my window. I've missed my window. I remember with 19, because it wasn't that long ago, gold was at 1,600. And I'm not saying that gold just goes straight up. It could have some severe pullbacks, and you could wait for those. And so the other answer to that question is, and you just answered for yourself, is what's your time horizon? Because if your time horizon is 10, 20 years, as opposed to the next fiscal quarter or year end, and that's why a lot of family offices are afraid, because the CIOs or bankers or ex-bankers, their performance is measured, their salary is measured by their overall return. If gold pulls them down, they're thinking one quarter, one fiscal year. If you're actually being a fiduciary, you don't want all your boxes and allocations to be green. That means you're doing something wrong. But if you're thinking 10, 15, 20 years out, whether you bought gold at 3,300, 2,900, or even 1,800 is going to be immaterial. My target, like Ronnie Sturflis for the next couple of years, is 4,800. But I think it's going, and again, I'm not saying this to just throw it out there. We're going to revalue gold. It's going to be part of the new reset whenever and however that involves. It's certainly replacing the 10-year. We're looking at gold at 10,000 conservatively, not next week, not even next year. Could be, but I have no idea how to predict that. But if I'm looking 10, 20 years out, it's going to be much, much higher than it is today. And whether you bought it 33 and change or 36 and change will be irrelevant in the long run if you're thinking that way. If you're trying to trade commodities, trade futures, or trade precious metals like any hard asset, you better have your stop losses in place. You better be looking at your Bollinger Bands, your Keltner Bands, and all that. If you're purely a speculator, that's a very different question. And I'm not the right person to ask. I've seen many commodity traders fail miserably at trying to time short or long hard assets. But again, if gold does go to 4,800, then to 6,200, then to 10,000, Again, that doesn't mean that you're doing the world is doing well. That doesn't mean that you're being richer, but that just means that the cost of a car tire or a house or a new mattress is going to be significantly higher. You can also certainly get price appreciation, but as Egon I say so many times, it'll be a sad day when gold's at 10,000, but thank God I'm in it. And again, I use Egon as an example. He had made a lot of money as the chairman of a FTSE 100 company. He could have done anything he wanted with. He could have invested in any asset class. He bought gold at 300, not because he was trying to get rich when gold went to 3,500. This was 20 years ago or 25 years ago. He was just thinking, whatever money I made, whatever money I'm going to earn, it's going to be in a paper asset. It's going to be in a fiat currency, whether it's a Swiss franc or a euro at the time, or at that time, even before, a Deutschmark or whatever. But he wasn't thinking, how can I get rich on the money I have and get richer? He was thinking, how do I preserve my wealth? And that sounds very boring. So he just bought gold at 300, a lot of gold at 300. Now, of course, when gold goes from 300 to 3,500, he's extremely happy with the price appreciation. He actually got richer, but more importantly, he didn't get poorer. And that's kind of the model we look at. Yes, he got much richer by investing in gold, but that was never his motive. But you will get richer with gold over the next 20 years, even at these price points, is my short answer. I guess I say think like Egon. And he's been an immense mentor to me because I'm thinking 20 years out and I'm thinking of my grandkids and my retirement, so to speak, or whatever. I don't really need to be worried about polo ponies when I'm 75 or a new car. I don't really have the desire to get richer, but I could get richer on gold. But more importantly, I know I won't get poorer. And I'm saying that, again, Egon was all about wealth preservation, but yes, he also benefited from massive price appreciation and massive returns. And I think you can get both. And it's a long way of saying if your window is reasonable, respectable, and if you have conviction, because not once did Egon sell his gold when it was ripping into the 80s and then going down and these highs and lows. He just stuck to gold because he had the conviction that eventually paper money would do what it always does and go back to its intrinsic value, which is effectively zero. Now, I'll repeat, when measured against a milligram of gold, the US dollar has lost 99.1% of its purchasing power since 1971. We went off the gold standard.
Matthew Piepenburg highlights a critical market disconnect through the gold-silver ratio, which signals silver's underperformance despite gold's bull market momentum. At 90.951, with recent extremes between 94.123 and 90.075, the ratio indicates silver remains significantly undervalued relative to gold. Piepenburg notes that silver typically outperforms gold during precious metals bull markets, yet this confirmation hasn't materialized. The current ratio near 100 to 1 suggests either an incomplete bull market or silver preparing for a substantial catch-up move. This absence of silver's characteristic outperformance raises questions about whether the current gold rally represents a true precious metals bull market or simply a gold-specific phenomenon. Historical data shows ratios above 100 to 1 consistently revert toward the 60 to 65 to 1 mean. During the 2008 to 2011 bull market, the ratio contracted from over 80 to 1 to below 40 to 1, with silver delivering substantially higher percentage gains than gold due to its smaller market size and greater volatility. This mathematical reversion typically translates into silver experiencing outsized gains as the ratio normalizes. Let's get back to the interview.
This is actually an indication of the gold price too, and this is my thought on silver. I mean, the gold silver ratio is hovering 100 to 1, crazy. And you think we're having this gold bull market, and yet silver, it's made moves positive, but not the dramatic moves where it really outperforms gold, which is confirmation of a gold bull market. And we've seen that throughout history. And we're not seeing it now, so that would make people think, has silver gotten less appealing? My answer to that is we're not in the gold bull market yet, even though we've seen these all-time highs. Silver's lagging because gold hasn't really begun its bull market rip. I really believe that. I'm not here to predict, there are people on TV or on certain shows calling $600, $700, $800 silver. I don't know, or even $5,000 silver, $4,000 silver. That's a mug's game again. I know at 35, 36, or 37, it's going to be much, much higher than that in the years to come. So it's just a great high-class problem to wonder, will it be 50 next year? Will it be 60, 70? But I think the gold-silver ratio, we're not seeing the kind of the ratios we saw in 1980 or 2011 at 15 and 32. too. We'll see it again. And I don't know when. What I think the silver quote unquote lag, although it's certainly higher than it was 5 years ago. But I'm saying the lag in silver right now is because we haven't really seen the bull market yet in gold. I don't think we have. And yet it's done extremely well this year. It's the highest performing asset. I think this is just chapter one of the gold story. I really do. And Egon, you could argue at $300 was chapter one. And but I think for the next 20 years, we're going to look back at $3,000 gold and say, what a bargain, sadly. And yet, even if there is a reset or a Bretton Woods 2.0 or a Plaza Accord 2.0, and we somehow magically get cooperation in a beautiful mind John Nash way with the BRICS and the G20 and everywhere else, even if we get that, whatever new system to come, and even the IMF has said this, despite its central bank digital currency programmability and trackability nightmare, for anything to have credibility in this new reset, they've said it. The BIS has said it. The IMF has said it. The World Bank has said it. For it to have credibility as opposed to just another new electronic fiat, it has to be covered in some significant ratio with a hard asset like gold. And so gold will be, again, playing a part of the new system to come. However smooth, ugly, discredited, or crazy, or whatever pain we have to go to get to that point, that reset is coming, and that new money is coming. And that new money doesn't mean a gold-backed dollar or a gold-backed euro, but it's going to be a gold-covered central bank digital currency. Will it be next year, next week? I don't know. But they're already moving in that direction so rapidly if you follow the puck. Again, it goes from gold no longer just being an allocation or a debate about low inflation, high inflation, low rates, high rates, strong dollar, weak dollar. It's broken from all those correlations. Now gold is simply becoming a strategic reserve asset for the new system. And that's, I think, not spoken of enough. And that is not pie in the sky. That is not sensational. That's actually happening. So yeah, silver is, I think, lagging only because gold hasn't even begun to rip yet. And I think silver right now at these prices, if you're patient, as Rick Rule said, silver rewards infrequently but extravagantly. Some people say it hasn't done enough for them. If you bought silver at 22, you should be content at 36, but you'll be very happy when it goes into triple digits. And silver is that little speedboat that rips past the juggernaut of gold. It's also more volatile too. So you got to pick your window. What's your exit? What's your entry? I'm going to buy silver so that when it rips, I'll sell it at a certain point. I'll never catch the high. Top, no one does, and then I'll use that to buy more gold. Hopefully, when gold is lagging silver in the growth space, but that's what most clients do. Silver is to speculate when the situation's right. If you're patient, it will reward you extravagantly. Sell, buy more.
Despite recent highs in gold, silver's relative underperformance, combined with the historically high gold-silver ratio, suggests that the whole bull market for precious metals may still lie ahead. As gold continues to establish itself as a strategic reserve asset in a shifting global monetary landscape, silver's time to catch up may be approaching. For patient holders, the current gap between gold and silver offers not just perspective, but potential. Is silver's current lag behind gold a sign that a major breakout is on the horizon as the gold bull market begins to accelerate? Share your thoughts in the comments. If you found this video helpful, give it a like, share it with others, and don't forget to subscribe. Only 2.6% have. So hit that button and turn on the bell for more insights on gold and silver.